Is our money broken? Is it in the process of breaking? Currency debasement is an odorless gas. It fills the room slowly, and by the time you notice, the damage is done. The famous economist Milton Friedman once said, "Inflation is taxation without legislation." To help make sense of this present economic environment, we will hear from political author Dominic Frisby and macro analyst and investor Lyn Alden.
I think the overall challenge right now is that the inflation we're seeing now is fiscal-driven inflation. If you look back over time at the inflationary periods and the sources of money creation, they can be very different. And so the 70s, that was a demographics bulge, and so you had a lot of credit creation, a lot of bank lending-driven money supply growth. That was actually bigger than the deficits we were running at the time. Whereas the 1940s, for example, that inflationary period was because of tons of money printing for the war. And so far, what we've seen in the 2020s is the second type. We've seen very fiscal-driven inflation, not excessive bank lending. But the Federal Reserve's tools are exclusively designed to deal with either trying to accelerate bank lending or slow down bank lending, as well as things like control the wealth effect and things like that. They're not really designed at all to deal with fiscal-driven inflation. The best they can do with fiscal-driven inflation is try to slow down private sector stuff so that it offsets the fiscal side. What we're seeing now is that the Fed is harming certain industries, for example, banking system, commercial real estate. Arguably, a lot of this does need to be cleaned out. The challenge is that they're also blowing out the fiscal deficit with higher interest expense, which in the 70s didn't matter because we had 30% debt to GDP. But now that we have 120% debt to GDP, it becomes weird because the effect from, the inflationary effect from those larger deficits from the higher interest expense can actually offset some of the slowdown you get in the private sector from trying to squeeze those. So I think since then we've been stuck in this limbo with central bank tightening. We're starting to see some of that disinflationary pressures, and I think a lot of people assume that once that goes down, it's just behind us now. Whereas I think an issue is that inflation is ready to return should, for example, the Fed eventually pivot or get dovish in some way. Basically, as long as the supply side's unaddressed, it's ready to come right back.
Now this, I think, is the most telling chart in the whole world, and it comes from our man, Our World in Data. But if you look at that chart, you will see the price of goods and services was pretty constant for 350 years. And it's only since the 20th century where the price of things has suddenly gone bananas. And if you look at this chart shows it more clearly. It's a logarithmic chart. This chart shows consumer prices in previous centuries. So there's the 20th century where the price of everything has gone nuts. But now we're going to look, this is the 18th century. Look at the prices of things in 1816, that was the great recoinage. And by 1900, they were much lower. Stuff got cheaper all the way through the 19th century because money was sound and it couldn't be debased and printed. But that's an incredibly telling statistic. And if you want to understand the inequality gap, those are your two charts. Now, money, of course, then was gold.
Somewhat cartoonish nature of the Fed's tools in either direction. Basically, if they're trying to slow down inflation, they're literally trying to increase unemployment levels and hurt the wealth effect. And, it's kind of a funny thing for what is basically the fourth branch of government to trying to be do. On the other hand, when we're in a recession and inflation's low or sometimes even negative, they specifically want to debase currency, debase savings, debase wages to try to reaccelerate more debt growth. As though that's, it's short time preference thinking. It says, okay, more debt can get us out of this recession. But then, okay, what happens when you just keep accumulating debt, recession after recession, decade after decade? The Fed has these very blunt tools that are just very powerful for a centralized entity to have. Like, we wouldn't want some sort of central agency determining the price of beef or a bunch of other things, let alone the price of money itself, the price of credit, arguably the most important price of all. And yet that's the system we have right now. And it's very kind of, they have models to guide them, but at the end of the day, it's basically 12 people in a room deciding what the price of money is.
Policymakers, institutions, and governments may decide the fate of our currency. It is our responsibility to safeguard the wealth we have, because no one else is going to do it for us. If you are interested in protecting your retirement savings and preserving your purchasing power through a tax-deferred gold IRA, see the links in the video description. Thank you for watching.